Welcome. This is a session as part of New York Climate Week, and it's been a busy time recently. The Federal Reserve announced that it will run a climate scenario analysis exercise on the largest US banks in 2023. The OCC has appointed its first chief climate risk officer. The Network for Greening the Financial System, a coalition of over 100 financial regulators, issued its third set of climate scenarios. And those are some of the bigger climate risk related pieces of news flow, not over the last year, not over the last quarter, not even over the last month, but over the last 2 weeks. And in the last month, in response to the Dutch government unveiling plans to limit nitrogen oxide emissions from its agricultural industry, the Dutch bank Rabobank classified its entire 10 billion euro exposure to the Dutch dairy industry as stage 2 under IFRS 9, indicating a heightened risk of default. So a really not just a piece of regulation or standard setting, but a really interesting piece of transition risk related news flow that is actually stimulating change in the valuation of balance sheets and assets. 70% of global GDP is now covered by a national or regional net zero target. And while the financial services sector and governments are making rapid progress on climate change, 3,500 companies in the real economy have signed up to the Science Based Targets initiative. So we're in this period of rapid advancement of the climate change agenda globally. We're going to turn our attention back in this session to the financial services sector. In a recent global survey over the last 2 years, 2/3 of financial services firms have hired a significant number of climate-focused employees, and 40% expect to hire more over the next 2 years. A few of those in that survey have already hired more than 50 climate risk professionals. So in a moment, we'll discuss what all of those newly employed people are actually doing. But first, I'll ask the panel to introduce themselves. Antonio from BlackRock first, then Sindra and Michael from Baringa.
Sure. Thank you, James, and thank you, Baringa, for the invite. It's great to be here with our partners. I'm Antonio Silva, and I'm currently the head of the Aladdin Sustainability Lab at BlackRock. I've been with BlackRock for 7 years, but literally my life has been all around models and analytics for portfolio management. Our interest has been, drifting over the last 3-4 years for models and analytics, very connected with climate. And so within BlackRock, we decided to centralize a lot of that research around models, around analytics, around technology under the Sustainability Lab in Aladdin. And so that's the group that I'm happy to head, and very happy to be here talking about this very exciting topic today.
Great, thanks, Antonio. So Sindra Maharaj, I am a partner at Baringa, based out of the US, so based out of New York, and working predominantly in the financial services sector. I currently head our US risk advisory work that we're doing, and my background's really centered, very similar to Antonio, around models analytics, but mine is really centered around treasury management. And if I think about the intersections of treasury and financial resource management, having spent a large number of years working with large financial institutions in this space. More recently, my team and I, together with James and Michael from Baringa, have been working very much in the climate risk space and working with a number of financial institutions, helping them to start to think about how do we embed this within their particular enterprises.
Thanks, Sandra. Hi, everyone. Michael Elter, my name. I do work in Baringa's UK practice in financial services, climate and sustainability. My background, I used to advise banks mainly in the capital market space, where I help them implement regulatory change such as MiFID, help them design risk operating models, so closely work with the first line and second line of defense, but also work with the business in launching new products and opening new branches, like in new markets. I'm now fully focused on helping financial institutions really address climate change, and there are 3 key areas that I have been focusing on. The first is embedding climate risk. So I'm currently helping a client to embed their climate risk consideration into credit risk management practices. Secondly, helping banks engage with their clients. So I've led the largest client outreach on climate in the industry, and help a bank engage clients as part of a regulatory exercise in the United Kingdom. And thirdly, I help design and implement capability building initiatives of banks across the organization. So as part have upskilled more than 10,000 bankers and individuals in risk.
Thanks, Michael. And finally, James Belmont. I am Climate Risk Lead for Financial Services at Beringer. I've led our work across climate scenario modelling that led to our partnership now with BlackRock. I've led the work that we've done supporting 10 of the 18 participants in the Bank of England's climate scenario exercise last year on climate scenario analysis. And I lead our work embedding climate change into financial services firms' risk management frameworks and net zero strategies. Okay, we're going to turn our attention first to one of the areas that is receiving the most focus from regulators and from investors, and that is scenario analysis. So, Antonio, can you help us understand how climate scenario analysis can be used and what good scenario analysis looks like?
Absolutely. Let me just probably provide some context for how we think about this at BlackRock. So our our starting premise is relatively simple. We do believe that climate risk is investment risk. And so it is very important that as you analyze investment risk, as we analyze investment risk for our clients, that we think around climate risk and integration of that climate risk into the full analysis. At BlackRock, we also believe, independently of what you think around climate change, we do believe that the economy transition from a high to a low carbon economy, it's ongoing. It's ongoing. It's actually accelerating, namely through significant changes on technology, on consumer behaviors and preferences, and obviously, as James was also saying, around policies and regulators. It costs like 85% less to provide to produce energy from solar systems than what it did 10 years ago. Another point of acceleration is, for instance, on the demand for electric cars. It doubled in 2021. It's triple actually for China. So not only the transition is ongoing, we do believe it's accelerating. And as it accelerates, it's completely rewiring and transforming large swaths of our economy, whole sectors, whole supply chains. A good example of that is obviously the auto industry, but almost every industry you can think of the rewiring that is happening. So as the transition unfolds, we believe that there's going to be a lot of risks, obviously, but tremendous opportunities also as that transition happens. We know that it's going to be an historical investment opportunity. For instance, the IEA believes that we'll need to invest on this area around $4 trillion per year. That's kind of 4 times more what we are typically what we have been investing. We also know that we need energy that is at the same time sustainable, affordable, secure, and obviously there is no current single source that provides all 3. So a lot of activity that is possible and that is predictable from the industries and new technologies that should be developed throughout these years. Same thing will happen with jobs. As a lot of capital is required, we do believe that jobs will also explode on this area, and so there is a prediction of around 30 million new jobs on clean energy and innovative technologies for 2030. So a lot of things are going to be happening. We think that the transition is already ongoing. And so given our beliefs and given obviously our fiduciary obligations, we are very keen on understanding how we incorporate that information into the investment processes that we do on the behalf of the clients, or that many of our Aladdin clients are doing on the platform. So it is important to emphasize that this is the topic most clients are interested on, not so much on the why should we care, why should we think, why this matters, but much more on the how and how to engage. And BlackRock view and BlackRock working with clients is really to help them understand, help them navigate, and if clients decide to, help them accelerate the path of that transition. So that is kind of the general context. And sorry, it was a little bit long, but I think it's important. And so with that context, what we do believe specifically on the analytics and modeling piece on the technology side on Aladdin is that we need the right set of data, the right set of models, the right set of analytics and technology. And so that's the work that we have been doing at BlackRock, and very specifically at the Sustainability Lab. What we think it's really needed for us to analyze this transition and to understand the impact it may have is really three foundation blocks for the analysis. We do feel that, number one, we need a very good and robust complete scenario analysis capabilities. The second one is obviously we need then the fallout from these scenario capabilities. That is, what is the impact in terms of the transition risk and the energy transition that we will see across the economy? So that's block number two, transition risk. And block number three, equally important, is obviously physical risk. And so independently of your views about the transition, there's going to be a fallout in terms of the balance on our natural world, or imbalances in this case, with consequences around economic perils given by physical risk. So we do feel that these three pillars, scenarios, capabilities, transition risk, and physical risk, are just very, very important, and they are going to be foundational no matter what you want to analyze. So we have been developing those models and those capabilities with our investors, with our clients, but very importantly also with our partners, being one key partner for us along this way. And so we have been very proud of co-developing these models with Baringa. Let me just detail, before I finish, I think it's important, a few considerations about these three pillars. Starting with scenarios. This is absolutely fundamental, and one may argue that we have a good starting point industry-wise. We do have a good starting point. There is some normative scenarios that are being put out, and rightly so, by NGFS, by the IEA, by the IPCC. And so these are all very good benchmarks in terms of normative scenarios. And I'm calling them normative because they typically are answering the question, what needs to happen for a particular outcome to come about. And so the more standard ones are those that are questioning or are trying to answer the question of how we'll transition to a net zero economy by 2050, right? What we think, though, is that although very important, these benchmarks are insufficient, right? And so it's going to be very important for you as an investor, for you to be able to impose your own views on how the transition will unfold. Not so much how it should unfold, but how you think it will in practice unfold. And different views about this transition obviously will bring to very different outcomes in terms of your approach, in terms of the way that you're thinking and you're managing your portfolio. So scenarios and the ability for you to translate your views on the transition on those scenarios are very important. Then on physical risk, quite important also to understand, obviously, to have a nice coverage of the different perils, from seawater level to to temperature rise, to extreme heat, to flooding, to all those things, but have that all integrated and coordinated with the other pieces. For that, you definitely need expertise that for us, financial economists and financial modelers are really new. These are capabilities that we're going to talk a little bit later on, but capabilities around physical sciences and climate sciences and all that. And so we're happy to be building a team with that level of expertise. And finally, on transition risk, I think something that is sometimes not emphasized enough is how important it is for you to have the right sectoral expertise and the right expertise in energy transition directly modeled into your framework, directly modeled into the analytics, so that you have a credible view about the transition. Obviously, the transition will unfold very, very differently across different sectors. And so it's just very important, very, very important that you have the right expertise and the right detail on the models so that you can look at and impose your views and see what is a realistic outcome industry-wise for that particular view. So the last thing that I would emphasize is that obviously we are, as an industry, and especially comparing other areas of research, what we have been doing in 20, 30, 40, 50 years, this is certainly a nascent area. And so we do think that as we are developing our common understanding, we're going to be deeper and deeper and deeper in that journey to fully integrate these models and these analytics into the investment risk platform or the way that we construct portfolios. But obviously, as we do that journey, there is very relevant use cases and very relevant outcomes that we can use those models, these models already for. So regulatory reporting be a very, very important one. We, with Boringa, have been engaging with many clients around regulatory reporting. Certainly other use cases like we are seeing increasingly around decarbonization and trying to understand commitments. So definitely a long journey, but one that is in steady progress as we walk towards maturing our understanding on this industry. So as a summary, we need the right foundation and the right foundational models and the right foundational data to construct a good scenario capabilities. We need the right benchmark scenarios, as I said, but we also need the ability to express our dissident views on how the transition will unfold. And we need to realize the nascent nature on this field. And so working towards integrating climate risk in our investment workflows and processes, but through a process of learning and maturing of these analytics. And I know we're going to touch, hopefully, that a little bit later on. So I'll stop here. Sorry for the long answer, James, but it is an evolving topic.
Thanks, Antonio. So, I think we see different financial services clients applying this discipline of scenario analysis to quite a wide range of asset classes, depending on what they have on their balance sheets or in their portfolios. So everything from corporate and corporate equity and debt to private debt, big with our banking clients, where 75% of a banking book tends to be unlisted private entities, sovereign debt, real assets in the case of asset managers and asset owners. When you're looking at banks, they're assessing real assets in the context of mortgage portfolios of upwards of millions of properties, even all the way down to individual vehicles in vehicle leasing portfolios, where they're exposed to the residual values on combustion engine vehicles as they get phased out. So there's quite a wide range of assets that companies are subjecting to scenario analysis. I know, Michael, given some of your experience recently, it'd be interesting just to get your reflections on how it's changing the nature of banks and other financial services providers' engagement with their counterparties or their borrowers, their portfolio companies.
I can provide some insights, James, in terms of I think, as Antonio also said, climate and climate risk data is relatively hard to come by. And if we think about clients, to look at their transition plans is important from two perspectives. Firstly, for assessing climate risk, but also for bank, can they achieve actually their net zero targets in terms of their financed emission, to look at the if transition plans of their clients are credible. And James, what we see is kind of the use of both, utilization both of scenario analysis output. We look also at temperature alignment scores, but also data which will be collected from clients directly, more qualitative data, to look at what are their long and short-term targets. Are the targets SBTi approved? What about operation investments to date? Emissions reductions achieved to date? So I think we see clients and banks utilizing several tools to get data from their clients to make their assessment. But I would say it's relatively early days, because there's no kind of common framework of how you would assess this. And I believe research suggests that less than 50% of firms who've made a net zero commitment have published their transition plans, actually.
So those 3,500 companies that I mentioned at the very start who've signed up to SBTi are all at varying stages of maturity. Some of them have got targets that are approved. Some of them have got targets that are not approved yet. For some of them, those are long-term targets. For some of them, there are short-term targets. And of course, there's a long tail of companies that have done nothing in the public domain, or at least not made any commitment to SBTi. So there's quite a wide range of practices in corporate world. I want to change tack a bit, and we were starting to talk about what it means for the day-to-day operations of financial services firms. Scenario analysis is clearly a very powerful tool for understanding the potential winners and losers of from transition and physical change in your portfolio, for understanding which companies and assets may be aligned with your own objectives. But it is just a tool to be used in a wider climate risk management framework. So, Sindra, can you describe in a more complete sense how financial services organizations can manage climate risk effectively?
Yeah, sure. Thanks, James. So 100% agree. I think that when we think about climate risk, especially within financial institutions, it's really, we're starting to see across the industry how firms are starting to embed climate within their overall risk management strategy. So it's their strategy, their processes, their procedures that they already have. And I think what we're starting to see and what's starting to emerge is climate is actually is a risk driver that's cutting across a number of different risk stripes. So if we think about it from just leveraging a typical risk management life cycle, a lot of firms are undergoing the idea of a risk identification process, looking at climate and looking at their balance sheet, looking at their positions, both assets and liabilities, and starting to think through what is the climate impact on that. And what's a little different when doing this versus some of the other risk stripes is the level of granularity that you need to go down to here. And I think we started to talk about that a little bit from a data perspective. So this is really going down and saying, okay, for example, on my loan book, and it's my property loan book, well, how do I start to segment that? Or my transportation lending book, is it via air, is it rail, is it road, and starting to kind of think about it on a sector by sector analysis. So step one is really going through and starting to look at the book and think through that risk identification process. We've been talking a lot about scenario analysis and stress testing, and that's really the next step, right? So what we're seeing is, as a result of going through this risk identification process, firms are not necessarily running their entire portfolios through scenario analysis right now. They're starting to look at it very much on, when they go through the identification process, what are those high emitting sectors? And a little bit of a prioritization exercise happening, and some of them taking on pilots to really start to understand what are the outputs telling us. And we're looking at outputs. These outputs can be looked at different layers of granularity. So are we looking at these on counterparty by counterparty, bottoms up, that's helping with transaction-led thinking? And I think that ties very well into what Michael was talking about from a front office, starting to engage with your clients. Also looking at it on a portfolio and on a sector level as well. So looking at the outputs and starting to make sense. And I think, Antonio, you sort of mentioned we're all on a journey. We're all sort of learning together, and taking the outputs that we're starting to see from a measurement exercise is a big part of where we are today in the industry. I think that ties very neatly into the next step when we start to think about the risk management life cycle, which is around monitoring. How do we start to use these outputs to make decisions? So looking at the PD LGDs, for example, that may be coming out at counterparty levels, well, how do those stack up against our current PD and LGD models? We all know the scenarios are extremely different. The time horizons are extremely different. So starting to get a sense of looking at that side by side to start to look at impact. And then last but not least is managing and reporting. And I think from that perspective, a lot of firms are starting to use the TCFD framework to help kind of put the picture together of how this will start to look like from a disclosure perspective.
Thanks, Indra. And I would reflect, given that picture of looking at different risk stripes and looking at different stages in the risk management life cycle, that picture of what you're trying to achieve, particularly for those firms who have their own balance sheets that are regulated, so banks and insurers in particular. If you're that kind of firm, probably the single biggest determinant or just distinguishing factor between those firms we've seen who've successfully mobilized their programs and those who mobilized them in a fashion but had to remobilize them with new budget and new resource requests. The single biggest factor that really determined who, which firm fell which side of that line was whether or not an individual firm had articulated what it was trying to achieve. It sounds simple, but a lot of firms set off without articulating their target state for their climate risk framework particularly clearly. They had nothing they could hold up to a regulator or internally to say, this is what I'm trying to achieve. This is how I'm going to weave it into the credit process, into the investment process. This is how I'm going to use it to assess my operational risk, and so on. That ability to define climate change or climate risk target status is critical. I wonder if it's worth also touching on board reporting, because I know, there's a exercise in mechanics and understanding how do you embed mechanically climate risk into decision-making processes of a large organization, but there's also in some of the larger, more complex firms, the importance of engaging the board and the exec in the right high quality kind of conversation with the right information is really key. I made that as a statement, but anyone. So my observation is it's key. If anyone's got any direct experience of that, be really pleased to hear it.
I can detail a bit. Obviously, a lot of the work that we're doing here at BlackRock is managing entire books of assets for clients, namely through our OCIO mandates. And on those CIO mandates, definitely has been the request is increasing over time on making sure that they understand well not only the impact that their decisions, their portfolio, their footprint may have. And by the way, that is a task, as we have been discussing. The data is a bit scary, and you need really to do a good job on understanding the data, understanding the limitations of the data, understanding the assumptions that we are making as you're forecasting things like decarbonization and all that stuff. So that's important. But obviously, that impact on the planet is important, but also obviously the opposite is quite important too, especially, as I said, given our fiduciary duties, we really need to make sure that those clients understand well the financial impact of their portfolio, of the transition, and all that. And so as we advise them across the board on the many different areas in which or how we are managing their portfolios, definitely discussions with the board and what is the right level of data, what is the right message, what are our particular views and mandates that particular client may have. It is very important, and we have been involved on those discussions, as I said, across many different clients, but I would emphasize, for instance, the OCIO clients at BlackRock.
Yeah, that connection between climate risk and net zero, they are clearly related. They use much of the same data. You should have the same view of whether an individual company's transition plan is credible to inform your view of their climate risk and whether they align with your net zero strategy. But they're different things, aren't they? So, and one of the things that I think we see increasingly, and particularly over the last 6 to 12 months, is the importance of being able to help organizations to see the opportunities to finance transition, so that if you're in the front office of a bank, or if you're in the fund management or investor community within the asset management and asset owner industry, you see climate risk and net zero as not as another thing to solve for, but as an opportunity to grow balance sheet. And there's, we know that there's going to be $300 trillion worth of investment required if we're going to get to net zero. That's the rough order of magnitude of investment required over the next 30 years. So even if we don't get there, even a fraction of that is a very large number. There must be significant opportunity out there for those firms who are able to identify when governments are going to shift policy, what kind of policy interventions are they going to make, how is it going to lead to changes in the value chains of how we heat our houses, or how we transport things, or how we make steel, or whatever the process is. So being able to
and James, just where that's why I was thinking that, and I was saying around, the maturity that we're seeing, increasing maturity on the usage of this information, right? And you're absolutely right. I don't think as of now the mainstream use of our capabilities are around expressing directly your views and make decisions based on those views. I think we're not there yet, but I do think it's a competence that not only is needed, is going to be required for someone that wants to have a competitive advantage on this field. As we know, portfolio management is around having views and dissident views and sometimes contrarian views around inflation, around the yield curve, around the equity markets. We do believe that not far from now, in terms of time, 2-3 years from now, we do believe that views around the transition will be, let's say, on the mainframe. And so having not only ability to understand and express those views, but then the ability to transform those views into actionable portfolio management actions will be absolutely key.
Yeah, I just wanted to take one step back, James. I think one of your comments at the start was a little bit around the reporting and the level of board engagement on this. And I think I like the word that you just said, Antonio, around level of maturity. And I think that actually is at least what we're starting to see in the US, that level of maturity curve is starting to, we're starting to see firms and boards move up that level of maturity curve. So some of the initial training sessions that we would hold were essentially around what is climate risk? What is net zero? How are they different? What do we do with this? Is it just something that we have to do to tick a box? Is this really going to be value add to my business? And I think we're starting to emerge out of that thinking to, okay, this can really move the needle and be a competitive advantage for us as a business. And I think that kind of ties back to, and if we start to think about it, this climate risk embedding that we start to think about, and how do financial institutions start to embed climate risk within their own decision making, their own credit risk decision making. But then there's also net zero embedding, and they are separate and distinct. So unlike climate risk, which is typically led by the CRO, our belief is net zero shouldn't typically be led by the risk organization, and that ownership of this is really important, and likely finance has to play a role in this. So similar, where you have a net zero commitment that you're making, it's another thing that like your financial planning and analysis sort of forecasting process should definitely solve or help start to solve for. So we're thinking about your net zero commitment alongside the ideas of, healthy cost income ratios or capital positions and returns on equity. So really, when you start to think about embedding net zero into your processes, it needs to be part of your annual financial planning process. And I just, when I introduced myself, I mentioned I come from a treasury background. So I'm going to arguably say transfer pricing over time can play a role here a little bit. And similar to funding, we may eventually get to a point where you centrally sort of put a price on your financed emissions in order to drive front office and business decisions towards allocation. And I think James and I definitely have some debates here on, will we eventually see sort of an emergence of like a carbon treasurer, possibly folding into Treasury's existing like FTP roles? I think we're a little way off there, but I don't think, never say never on that front. But I think that's a really key as we start to think about, and the work that Michael was saying is, how do we get our front office and get some of the front desk to figure out how we, build out with relationship managers? How do you start to originate new business with this in mind?
All of which I think takes us sort of very tidily onto the final topic that I wanted to cover before we open it up for questions. So by the way, if anyone wants to ask questions in the last 10 minutes or so, please just drop them into the chat and we'll pick them up and answer them in the last few minutes. But Sindra, you were talking about that kind of change of focus from external facing statements, engagement with regulators around climate risk, understanding climate risk at the firm level. There may be some firms who are making net zero commitments. These are all things that you're going to be potentially engaging with externally, but then the challenge comes that you turn around and you discover you've got thousands of people individually making decisions every day that you have to upskill, and you have to find out how do you help them to do their jobs better, more profitably, given whatever your view on climate change. As to Antonio's point, we all know that transition is a possibility. Given all of that, how do you upskill your teams so that you're making optimal decisions on the back of all of that? Michael, I wonder if we start there with you and your perspective on that.
Yeah, I think both Sandra and Antonio made good points, which showed already the complexity. We already talked about some of the teams that require upskilling. Sandra, you mentioned the board. In SEC's recent proposal for the climate-related disclosures, they said require disclosure of board climate risk expertise and expect board of management to be fully informed on this. So that's always a starting point. From a board perspective, you also mentioned finance teams, risk teams, and we highlighted the front line, especially the bankers. So I think what it just shows is that building capability, it will be a huge undertaking, and it's an area, it's a very emerging area. Banks learn, regulators learn, it's a very new subject. So I think when we work with organization, what it shows is, firstly, it needs to be made a management priority, a top priority, to really say we need to upskill the organization on climate. Secondly, is the realization that you need to develop quite a few learning pathways for different learners. They need to be sector specific. They need to address bankers. They need quite a different knowledge and understanding to engage their clients. Risk teams, they require expert knowledge. So you really need to get your head around what's the capability they require and then build the pathways. It should be embedded in a broader ESG understanding, not only climate. We have a lot of emerging themes. So it should be embedded in a broader understanding. And one of the key aspects often forgotten, that training needs to really have an impact and even inspire teams. This is not a point in time delivery of a classroom training or online module. That's really supporting your teams via a mix of modules that are engaging on the job learning, giving them the tools and framework. We discussed the credible transition plans. If you want your bankers to engage clients, they will require tools, they will require support on the job. So the upskilling is much more complex than just delivering a few training modules. And that was what we see when we work with clients. That's often it's a multi-year program that you now need to think about.
And can you just tell us a bit more about some of the front office reactions that you've had to some of this training in banks, or the investor reactions you've had to this from, in asset managers, PE, the sort of front office folk who might initially be skeptical of having to solve for another thing when writing new business?
Yeah, I think both Antonio and Sandra mentioned it. If you train bankers, they rather engage with you on opportunities that they can sell more products. So that's the approach which you should really consider. Just talking about risk, you may have some limitations in terms of their engagement. So I think it's I think Sindra, you said it. You need to look at the climate risk and net zero, and they're two different things. But when you engage clients, you need to think about both. And I think that's when you train your bankers. What we see is for them to see it as an opportunity to engage clients on a topic which is here to last, build a relationship, and ultimately build a business with them. So they need to see the opportunity. One other takeaway is when we work with clients, it needs to be really sector specific. A training oil and gas, they are on a very different transition drivers and in terms of urgency than some of the other sectors. So predominantly when we see in the market, it's always your oil and gas, your power, metals and mining, but you need to cover all the sectors and have a sector specific training that you need to consider with your frontline.
It's really interesting, this sort of sector view. There's one other trend that I'm starting to see, which I think is quite interesting, which is the biggest uncertainty in all of this is where politics will go that informs policy making. And so we're starting to see firms develop, alongside their sector understanding of technologies and value chains within individual sectors and how those may change, an increase in work to codify a view of political risk around transition. So there was a client recently who is invested across pretty much every one of the 50 states of the US, who developed essentially a sort of big bubble chart with lots of supporting detail of the climate, the transition risk, the political risk around transition in every one of the 50 states, saying, firstly, how strong is the policy? What are the policies in a given state, and how strong are they in different sectors? And secondly, given our read of the political dynamics, the mix of parties holding, the sort of electoral position in each state, for example, and the positions of individual politicians. Where might you, how strong is the momentum behind that policy? Do we see it strengthening, or is there significant rollback risk? And that was a really interesting way of starting to provide some comfort to investors investing for the long term, who knew that even though they were investing for the long term, transition risk can impact the value of an asset overnight if policy changes, or even not even if policy changes, just if there is a sudden change in expectation of what the policy might be.
Mm-hmm. And just to add to that, and what we observe is obviously every client is on a different path. If we compare APAC or Asia with Europe and the Americas, they're definitely at different levels. But what resonates very, very well, and that's why I was making such an important point a point on importance of scenarios, is exactly your ability to understand all those nuances, right? And your ability to understand, either you agree or disagree, what is going to be an impact on a particular policy, the impact of a particular policy on a portfolio. James, you were talking absolutely. I mean, if we're thinking on even simple things like carbon pricing, right? It will have a significant impact on investments, on the way the transition unfolds, right? But people have certainly very different expectations about how that will unfold, or about how fast consumer preferences will change, how fast the adoption of electric cars, or actually how fast can we produce electric cars too, right? And so it's just very, very important for you not only to have those views, but have a way to understand the data that you're using, therefore the transparency that you have around that data, but also the flexibility in which you can use it, so that you kind of understand not only what should happen, but a realm of possibilities of what may happen, so that then you construct a more holistic picture about what are your risks, what are your exposures, and if you're happy or not with your exposures vis-a-vis your views, obviously.
Yeah, and I think scenario analysis is not it doesn't give you the answer to everything. It's a tool for exploring, isn't
Absolutely.
it? So to your point, the electric vehicle point that you made is really interesting. We had a client who had a certain house view on the uptake of electric vehicles in China, and of course that house view has to coexist with an internally coherent scenario overall. So, their use of climate scenario analysis was to say, well, if I have this view of what must be happening to electric vehicle demand in a particular region, then I must also have an internally consistent view of what's going to be happening to the demand for power to power all those vehicles. And if I have a view on power, then I need the modeling to give me an internally consistent view on what's happening to the demand for various fuel sources, whether it be coal or gas, or the materials to make solar farms and wind farms. And that will have a knock-on impact on, for example, the marginal profitability of power generation activity, running an airline, all those sorts of things. So it is, what we almost always find is that most organizations will have some sort of house view on some things, but they need a framework within which they can construct internally consistent worldviews that capture their house views and tell them what else must be true for those house views to emerge.
And that goes back into what Michael was talking to regarding what kind of expertise you need to start building on your companies. And obviously, as I think we all agree, we are really in the starting innings of this process. But we do feel that, at least for many of our clients, they will want to go fully in terms of the full integration of these risks into the investment process. And so we're not there, but we do actually believe that we're going to be there relatively soon, 2, 3, 5 years. And so it is now the moment for our clients and for portfolio and portfolio managers, asset owners, asset managers in general, to understand if this is in fact part of what they feel is going to be their competitive advantage, if they would want to have views that then they can propagate around the transition, if they want to build products and build capabilities around these things, definitely now is the time to start building that expertise. It's a very, very different expertise than what we as an industry are used to hire, are used to manage, are used to pay, right? And so there is a series of mechanisms and a series of just better understanding of what is the right skill set and how to integrate it into our teams. That is quite important too. And so starting now is the right time if you want to be in a position where you can make the decisions that we were talking about 2, 3, 4 years down the road.
We have our first question in the chat, so I think, and we've got 7 or 8 minutes left, so it's probably time to turn our attention to questions, Q&A. And while we're going through this one, if others have questions, please type them into the chat and we'll come on to those too. But this first question, I think, is for you, Michael, and it is really interesting to hear your views on training and capability building. This sounds like a massive job and a bit daunting. Where would you advise people start?
Yeah, that's I think people usually have started already where there is the most urgent need. That's often in your risk teams. You have an event, you have regulation, which set out a certain expectation to embed climate risk. So you need to train your risk teams. They will usually work with your front line. So that's usually a good starting point. But as I said, because it's a huge undertaking, you need to look at this quite holistically. Who are the teams? I think make it a priority. Determine who needs what knowledge at which stage, because what you will probably find is that firms or institutions have a view we need to train the whole organization, and that's probably the correct view to have. But the question is, how do you roll this out, right? That it's not just like a mandatory training course or so amongst others, but how do you make it relevant? And so that's the reason why I think the starting point is often also in our experience, see where the most urgency is and make it a management priority. So you need to, usually we start the discussion often with the board, right, James? And you've been in many of our upskilling sessions. If you don't have the tone from the top, it's probably really hard to convince everyone else in the firm that's important, that they need to focus on this and really understand the impact on their role, what the impact is on their client, because that's what really relevant, right? What is the impact for us as a firm, for our role, for our job, for our client? That's what you need to be thinking about when you do upskilling.
Can I add to just a very quick comments? The first one, and I fully agree with you, Michael. But two quick comments. One is actually you will see that on all organizations there is actually a lot of people that are seriously interested and seriously motivated to learn fast about these capabilities, and it's a very natural resource to pick are these people that are really, really passionate about this. By the way, this is an important area more and more of for you as an institution to attract good talent is the ability to work on such a pressing issue as this one. The other one that I would say also, to complement Michael's answer is that probably in a majority of the investment organizations, there is obviously people that are already sector specialists. And so this thing didn't fall from the sky. Anyone that is working on the oil and gas knows relatively well these lingo and what energy transition means for their sector in specific. And so it may be low-hanging fruit for you to expand that knowledge to other sectors and across the firm.
Yeah, I'd add, and there's in every firm, to Michael's point about specificity of people's roles, take the time to understand how someone, how a small group of individuals is incentivized and what they feel that their job is. And for a lot of people, for most people in an organization, it is helping the organization to make money in various different ways. So, the subject matter may be similar, but the orientation of the conversation and the training that you deliver needs to be how you can help them be better, more successful at whatever it is their job is. And Michael talked about opportunities earlier, and how do you help people to see this as an opportunity rather than a risk.
Yeah, and James, Antonio made a really good point, and often the banks or the investment firms, they have a lot of the knowledge. Right, you said, Antonio, on the oil and gas, for example, they usually understand their clients or their investments, they understand transition drivers. So it's important to use these experts in identifying and delivering actually the training. It's quite important who delivers the training. It shouldn't be a generic training person. It should be the experts, ideally delivered by your own people to have a real impact.
All right. Looks like we're all done. Thank you very much for attending and for engaging in this discussion. I'm sure it's a topic that will go for months, years, and decades. There's lots of transition ahead of us to go. Thank you to Michael, Sindra, and Antonio for your comments as well. And enjoy the rest of New York Climate Week.
Thank you.
Thanks, James.
Thank you.
Thanks, everyone. Bye-bye.
Bye.